Hi, hi. Good evening, guys. Can you please confirm if audio video looks all right? Generally, there is a 30-40 seconds lag. So I've also opened YouTube on the side. I can see my video is not showing yet. So I'm just waiting for it to start streaming. Okay, it has started streaming now. All right, then. How are you guys doing? Good evening, good morning, good afternoon, whichever time zone you are in. Welcome to this session. It's going to be super fun. We are going to work on cost of capital. I would say it's one of my favorite readings in corporate finance, just because how practical this reading is, just because it helps you build a really good perspective on how to look at different sources of capital, how to raise money, why equity is expensive, if at all it is expensive. We'll see all of that. So today's session is going to be super fun. I don't want to spend a lot of time. Get started with the session right away. So just give me a minute. I'm going to fire up my writing screen, and then we should be good to start. Just a minute. We'll do a black screen today, just for fun. Okay. The notes will be available. We will upload them in the description of this video. So you don't have to worry about writing. Writing is not important. I want you to learn. Okay. Today is really deep concepts. Today is incredible fun. Like cost of capital by itself is such an amazing reading. So we're going to have as much fun as we can. And with this background, let me get started. So cost of capital. All right. So when we did capital budgeting, I did one example with you guys when I was trying to explain the IRR. I'm going to start my session with the same example. And if you've not seen that example, it's okay. You should be able to pick it up now. Okay. So imagine we have an individual here. Okay. And what that individual is doing is he, let's say, takes maybe a bank loan. Okay. And let's say he takes a bank loan at the rate of 15%, let's say an amount of maybe $100. Okay, 15 is too high, but just an example. And then he takes that money and he deploys that into market. So he deploys maybe $100, but he gets lucky. And by the end of the year, that $100 becomes 125. So when you study capital budgeting, which we did in one of the previous sessions, your focus is on the right hand side of this equation, right? Your focus is on that I have deployed 100 and I have received 125 in a year's time. So how much have I earned in percentage terms? So we did calculate a number in the previous class, which was 25%. We call this as the internal rate of return, right? So where to invest, how to invest, where to invest, or how to invest. So this question is answered by capital budgeting. Okay. But clearly, if you look at this, that capital budgeting is just half the side. It's just the right hand side that I have taken 100, I deployed that in stock markets, I deployed that in business, I deployed that in some great investment opportunity. So my 100 became 125. Good news. That was capital budgeting. Today's focus is not on capital budgeting, but today's focus is on how to raise money. Right? Today's focus is on how do I raise this 100. Now, in this example, I took a simplistic assumption of bank loan. I said that I'll go to a bank and I would raise 100 from them. But that's not necessary, right? Not necessary that that's the only way I can raise money. So how to raise money? What is the most cost efficient to raise money? That is what we are going to learn in this particular reading, which is the cost of capital reading. So how to raise money takes us to something called as the sources of capital. Right? These are the different ways through which I can raise money, sources of capital. How can I raise that 100, which I can deploy, which I can raise, and then I can deploy in some investment opportunity, right? From where can that 100 come? So you tell me, what are the possible ways through which we could raise that 100? Do you think we can raise only from bank, or you think there are some other options available as well? What are the ways through which we can raise that 100? The 100 that we need for our business, the 100 that we need for our investment. What do you think are the ways through which that money could be raised? So in general, we say that there are three sources of capital, three primary sources. So first source of capital, we call it as equity. Okay. And what do you mean by equity? Very simple. Equity simply means the promoters own money, the money that they're putting out of their own pocket. Okay, so that's their own money. So we call this as the equity capital. So this guy, let's give him a name. Let's call this cute looking fellow, let's call him Mr. X. All right. Now, Mr. X, he's going to raise 100. Doesn't have to be always a bank loan. Maybe 20 of it, could be raised through his own capital, his own money. So we'll call this as equity. But is that the only source of capital? Of course not. An alternate source of capital, very popular. He could go to a bank and take a loan, and doesn't have to be a bank. If he's doing a big business project, he can issue bonds, right? So we generally call that as debt. So debt is another source of capital. So either the money could be raised through equity, or the money could be raised through debt. It's a little bit of both. You can bring in a mix. You can bring some amount of money through equity, some amount of money through debt. But there's also a source of capital that sits right in between, which is like a hybrid. Okay. What do you think comes in here? Which is a little bit like equity, a little bit like debt. Tell me, what is it? Correct. That is called the preferred stock. Preferred stock, right? So think of preferred stock as some sort of a hybrid. It fits between equity and debt for some reason. As I go a little bit deeper and I explain this concept in depth, you'll start appreciating it. So what are my sources of capital? I can raise money either in the form of equity, or I can raise money either in the form of preferred stock, generally mostly an institutional play, not very popular retail product, mostly used by institutions, and I'll tell you which ones and how. And then we do debt. Okay, these are the three sources. And when I wanted to raise 100, I can use a good mix of two or three. Maybe I can do a something like 50, 20, 30. That could be one way of doing it, right? So I can raise the money. And in today's session, what we want to learn is, okay, if I'm going to raise money through equity, it might have a cost, it might not. We'll see that. So how do you calculate, if at all it has any cost of equity? How do you calculate preferred stock? How do you calculate debt? So each one of them is going to have a cost. Okay, so each one of them is going to have a cost. And we generally use these notations in the curriculum. This we will address as KE. This we will address as KPS. And this we will address as KD or KED. All right, we'll see that, what it means. And whatever the cost is, since I'm bringing money through all of them, I'm going to figure out some sort of a weighted cost, right? So what we calculate is, we calculate a weighted average cost of capital. On an average, But using the weight, depending on how I've raised the money, we're going to have weighted average cost of capital. And going forward, I'm going to address this concept or this number simply as WACC. Okay, so when I say weighted average cost of capital, or when I say WACC, it simply means weighted average cost of capital. And at times, you'd see that a lot of questions simply refer to this as the discount rate. Discount rate is kind of a generic term. All right. So discount rate or WACC, they would be used interchangeably during the reading. And of course, we're going to do all the calculations of cost of equity, cost of preferred stock, and cost of debt. Okay, so that's the background. That's how I want you to think of it. So think of it that capital budgeting was the right inside of this game where you take some money, you invest that somewhere, you earn a little bit of money out of it. You do your NPV, you do your IRRs. Cost of capital is left inside of this game where you figure out what is the most efficient way for me to raise money. So it doesn't always have to be a bank loan, right? It could be a mix of three sources of capital. It could be equity, it could be preferred stock, it could be debt. And we'll see how that works today. All right. So with this background, let's get started. The first thing that I'm going to do is I'm going to help you build a thought process on what preferred stock is. Most of us understand debt, most of us understand equity, but some of us might have confusion on what preferred stock is. So first we'll do a little bit of theory. Then I'll give you an excellent example of how private equity and venture capital industry makes use of this concept of preferred stock or some version of preferred stock. And once you guys are clear with what equity is, what preferred stock is, what debt is, then we will start doing calculations. First with cost of equity, then with cost of preferred stock, and eventually with cost of debt. And we will round up today's session by doing calculations on WACC and few final smaller concepts. All right, so that's the game plan today. So let us get started with equity. Okay, preferred stock and debt, the three types of products. Now, first question, as an investor, what are you investing in? So when we say you want to buy equity, what are you really buying? So when we say equity, what you really buying is you're buying something called as the common shares. You're buying something called as the common shares. The reason why they're called common is because these are called preferred. Right? So you want to compare them. So here what you're buying is you're buying a preference share. Preference shares and preferred issue are different concepts. A lot of people confuse them. They think that preference shares and preferred issue is same. No. Don't mix the two. No, they're different. Okay, I don't want to get into that now, but just know that this is a preference share. And debt, what are you buying? You're generally buying bonds. Right? All of you understand a little bit of how bonds work. So these are the products through which you can invest in them. Now the question is, if you buy common shares, are you an owner of the company? Are you a owner of the business? Are you a owner of the company? You tell me. If you're buying equity shares or common shares, are you the owner? Like, do you own the company? You guys are saying yes. So if you're owner of the company, when was the last time you fired an employee? You can't, right? Why? Because even though you're owner, or more specifically, you're a part owner. Even though you're a part owner, you don't intervene in the day-to-day business of the company. You appoint something called as the board of directors. And these are the guys who take care of the business on behalf of you. Correct? So yes, you are an owner, you're a part owner, but you do not intervene in day-to-day operations. You just get to vote whenever company calls for you. If you're buying a preference share, what do you think? Are you an owner now? If you're buying a preference share of a company, do you think you would be an owner? Yes, no, of course not. No, not an owner. Are you an owner here? No. right? So when you're buying preference shares of company, no, not necessary. You're not an owner. Next question. Fair enough. I understood this. Now, from an investor perspective, if you're buying these, how do you make money? Okay, if you're buying equity shares of a company, how do you make money? So in case of equity, tell me, do you make money through interest, or you make money through dividends, or you make money through capital appreciation? What is the source of your income here? So in case of equities, it's obvious you make money through something called as the common dividend, right? But is that the only source? No. You also get capital appreciation. Capital appreciation means the stock price goes up, right? That's the real charm of equities, isn't it? That's why the world is chasing equities, because you might buy a stock for 100 rupees and maybe in a few months, few years, it might be 200. So you get capital appreciation. But preference shares, how do you make money? What are you expecting to receive there? In preference shares, are you playing the capital appreciation game, or you're expecting to receive common dividend? What are you expecting to receive in a preference share setup? Come on, tell me what do you receive fast. In a preference shares, what you receive generally, how do you make money is by receiving something called as the preference dividend. Do you have capital appreciation? A lot of capital appreciation? Generally not. Okay, now don't hold it against me. Every asset can change in value. Every asset can give you a little bit of capital appreciation. But generally, when you're buying a preference share, you're expecting to make money through preference dividend. You're not really playing the capital appreciation game here. And how about bonds? Generally, you're expecting to make money by receiving what? By receiving the interest. Capital appreciation maybe once in a while, but generally the game that you're playing is you want to receive interest. At times, we also call this as the coupon amount. Right? That's what you expect to receive. You expect to receive the yield. You expect to receive a coupon there. Now, the next question is, okay, so I make money through these. Is the dividend slash interest rate fixed? Do I get a fixed amount of dividend every year? What is that regulation in India or even globally, which says that if to equity shareholder, this is the minimum amount of dividend you're supposed to pay every year. What is that number? That every year to the equity shareholder, you have to pay this much of amount. There has to be something, right? So what do you think is the minimum amount of dividend that we pay to the equity shareholders? Come on, all the smart people out there, give me an answer. What is the minimum amount that you think we should pay to the equity shareholder? The answer is no. Is the dividend fixed? No. You're at the mercy of the company. If they feel that they have made enough profit and they want to pay you dividend, they will. But can you force them? Can you call them and tell them, "Mera dividend aaya nahi, I have not received my dividend"? No, you can't, right? It's an equity share, so there is no fixed dividend. How about interest rate? Is there a fixed yield or a fixed coupon that you receive on interest? Yes, absolutely, right? So generally, there is a fixed interest rate. There's a fixed interest rate that you would expect to receive. Then how about preference shares? Is it fixed or is it changing? Preference shares. How about preference shares? Is it fixed or is it changing? It is a fixed rate. It is a fixed rate, a fixed preference dividend rate, fixed PD rate. So then the question comes, okay, if that's the case, then do I get dividend slash interest even if the company is making losses? Even if the company is making losses, right? So because it is fixed, will I get, when I get my dividend or interest, even if the company is making losses? And this gets very beautiful now. I want you to be super alert. If you're investing in equity, what do you guys think? Do you think you would receive? Do you think you would receive a dividend even if the company is making losses? No, absolutely not. Right? No question about it. I mean, they'll pay you dividend if they're making profits. Generally, loss-making companies would avoid paying dividend. How about interest? How about interest? Can the company call you someday and say, hey, listen, we're not making enough profits this year, so we think we'll probably avoid paying you interest this year? Do you think that's okay? Absolutely not. They will have to pay. If they don't, it's called a default, right? That has serious repercussions. So, do you get dividend or interest even if the company is making losses? As far as interest is concerned, yes. If they don't, it's a default, right? So what I want you to know is that the reason why someone would buy a bond is because there is a certainty of interest. No matter what happens, you keep on receiving those coupon payments unless and until company goes in default, which happens once in a while. Uh, but if you're buying equity, there is no certainty. If company does good, great. If the company doesn't do good, that's your problem. Now, how about preference dividend? Because notice a preference dividend has a fixed preference dividend rate, right? So what do you think? Do you get a preference dividend? Do you get a preference dividend if company is making losses? Yes or no? Because it's a fixed rate. So don't jumble up. You get a fixed rate like 10%. So do you think that you will receive preference dividend even if company making losses? Yes or no? Absolutely, absolutely no. That's why it's called as a hybrid. Okay. Why it's called as a hybrid is it has a little bit behavior like a bond. Why is it behaving like a bond? It's a fixed rate. But it also has a little bit of behavior like equity. Why equity? Because you get that fixed rate only if the company is making profit. So you get a preference in the dividend if there's a profit. You get a preference in the dividend if there's a profit. But if the company is not making profit, no dividend. Forget it. Okay, that's how it works. So in terms of preference in dividend. Okay, in terms of preference in dividend. So preference in dividend slash interest, right? Who gets the first preference, who get the second? So obviously, these guys you have to pay first. Okay, there's no escape from interest. If you default on interest, you're in a so that means you're getting into liquidation. That means you're in trouble. So these you have to pay first. After you've paid first, if you have any profit left and you decide that I have some profit left, now let me figure out what I have to do. So these guys will get a preference over equity shareholders. So if you're going to pay dividend, if you have profit, so instead of saying equity, let me say they'll get a preference over common shareholders. Okay, common shareholders. So if you're making profit, please pay preference dividend first. Then if you want to pay, then you can pay to the common shareholders. And these people will get last preference. So in terms of hierarchy, these guys would be paid last. Okay. Then what if company goes in liquidation? Liquidation means company is shutting down. The business didn't work. They're selling off all the assets. They're shutting down. So in case of liquidation, who is paid their amount first? Very important, right? In case of liquidation, who gets their money back first? So in case of liquidation, again, we have to pay the bondholders first. They will have a priority over any type of equity shareholder, whether it's common or preference, doesn't matter. The bond guys will get their money first. After the bond guys have got their money back, then these guys will get a preference over common shareholders. That means you have to pay these people next. Preference over common shareholders. And if any money is left after paying these two people, then we pay to these guys. So we pay them last if anything is left. If anything is left. Okay. Now, if anything is left, that's kind of a strange word because at times, something would be left, something would not be left. So when we say if anything is left, another word for that in English would be residual, right? Another word for that in English could be residual. That if anything is left, if there is any residual left over, then I will pay to these guys. And that is the reason why at times an equity interest is also referred to as a residual interest, right? And now it should make sense to you why we call that as a residual. We call it as a residual because these guys are paid last. These guys are paid at the end. Okay. So again, a super quick summary of what we've learned. Dividend, interest, whether you make profit or not, pay to the bondholders. But if you have profit, then pay to the equity preference shareholders, then pay anything left to the equity shareholder if you want to. It's not compulsory. Same logic works in liquidation. Okay, so we're going to do a few examples. You'll understand what I'm trying to say with this. Let me build some simplified examples for you. This is important. I want you to be clear with basics before I take you to more technical areas. If you're from accounting or a commerce background and you already know this, just be patient for another 10 minutes, because after this, I'm going to start with how some of these instruments are used in private equity world, okay, which is really interesting. So just listen to me carefully here. Let's say, let's do a nice example here. Let us say we have a firm which has issued equity shares of $1,000. Okay, they have issued preference shares or a preferred stock of another $1,000, and then they have issued bonds, okay, of another $1,000. Okay, so these are the three instruments issued. Now you guys help me out. Equity shareholder, I'm going to say there is a fixed rate of dividend that I have to pay. What rate should I put in there? Fixed rate of dividend that I should pay for equity. How much? Fixed rate of dividend. Should I have something? No, it doesn't make sense. There is no rate, right? But will a preference share will have a rate? Yes. So we'll have something called as a preference dividend rate. Is it interest rate? No, it's called preference dividend rate. How much? 15%. All right. Then we will have something called as an interest rate. And interest rate, you generally want to keep it a little lower than the bond, a little lower than the preference dividend rate. There's a logic to it. I'll tell you what, okay, later on. So let's say an interest rate of 10%. Let's keep it simple. Now let's assume that sales of the company is 500, and the operating cost means excluding interest, right? All the main business related cost, let us say it is 200. Okay, and the CEO wishes to pay equity dividend of, equity means to common shareholders. So 3 share, just give me a minute. 3 share, 240, equity dividend of, let's say 100. Okay, now we need to figure out can he pay that dividend or not. That's what we'll have to figure out. Okay, so the way we're going to figure that out is we're going to make a nice income statement here. We're going to make a nice income statement here. Starting point of my income statement, I want you to look at this very carefully. Things will be clear. Sales 500 less operating cost 200. When I deduct all the operating cost, what do I get? What is that number that I receive when I deduct all the operating cost? That number is referred to as EBIT, right? Earning before interest and taxes. Now, how much is that going to be? That's going to be 300. Now, from this EBIT, I don't have a choice. I have to first pay interest. Okay, there's no choice here. I have to pay interest. And how much interest I have to pay? How will I calculate the interest amount? So I've issued bonds of $1,000, so that's my debt. And interest rate is 10%. So how much will I have to pay? I will have to pay an interest of, come on, help me out. I will have an interest of how much? 100. When you deduct interest, you get something called as EBT. EBIT stood for earning before interest and taxes, and EBT stands for earning before taxes. Okay. So earning before taxes, how much? 200. From this, I have to deduct the tax amount. How would I figure out what the tax amount is? So notice tax rate is 40%. So whatever is my profit before tax, 40% of that. So 200 into 40%, the tax amount is going to be 40. If tax amount is 40, how much do you think I'm left with here? I'm left with earning after taxes, which is also called PAT, profit after taxes. How much is that? That is going to be 120. This is also called the net profit. All right. Now, what can firm do with this net profit? So they take this 120. Okay, the firm will take this 120. Let me increase the size a little bit here now. And firm will say, fine, let me pay 100 to equity shareholder, and let me pay 20 to preference shareholders. That's okay. Let me pay 100 to equity shareholder, and let me pay 20 to preference shareholders. Do you think that's okay? So this would be paid in the form of dividend, of course, right? So equity dividend and preference shares dividend. No? No? You think I can do it? What are you saying? Are you sure? Yeah, you're right. I can't. It doesn't make sense. Why would I do it? I'm not allowed to do it. What I'll have to do is I will have to give preference to these guys. Which guys? The preference shareholders. So what is the preference dividend? The preference dividend is going to be 1,000 into 15%. 1,000 into 15%. I'm supposed to pay 150. But do I have 150? No, I don't have 150. We do not have 150, right? We do not have 150. So then what do we do? So then pay as much as you can, as much as the company can, right? So how much can we pay to these guys? 120. So how much can you pay to the equity shareholder? How much can you pay to the equity shareholder? 0. Right? That's why we say preference. I hope now the word preference is making sense to you. The reason why we say preference is preference shareholders get a preference over and above the equity shareholders. Is it okay? Now what happens to that remaining 30? Because we were supposed to pay them 150, right? We were supposed to pay them 150. So the question is, what happens to the remaining 30? That's a good question, because as a shareholder, I'm missing out on, receiving preference shareholders. I'm missing out on remaining 30. So tell me, what happens to remaining 30? I'll give you two options. You tell me which one is correct. Which one is correct? Okay. One option, it gets carried forward to next year. And then next year we pay 180. Carried forward to next year, or lapsed. It lapses. You tell me. What do you think happens next year? Do you think carried forward to next year? So next year we pay 150 plus 30, or the 30 is lapsed. Come on. What do you think happens to, is it lapse or does it get carried forward? All the smart people here, tell me. Okay. The answer is, listen to this carefully. The answer is, the answer is, it, it depends. It depends. Depends on what? Depends on what? Depends on the type of preference shares we have. So it will be carried forward if it is a cumulative preferred stock, right? So within preferred stock, there are different types. So if it is a cumulative preferred stock, then whatever dividend that was lapsed will be paid back again. But if it was a type called non-cumulative, if it was a type called non-cumulative, then the answer is that it simply lapses. Correct? So whether it is cumulative or it is non-cumulative, that would really determine whether a dividend gets carried forward or not carried forward in the next year. Okay. So this is a background of three sources of capital: equity, preferred shares, and debt. Just an overview, not very granular. Now I want to spend a little more time on talking about what is the practical use of these preference shares. Okay, so when I was a student and I was studying for it, I used to try and look up, I used to try and look up, on the websites, and try and figure out where can I buy, these instruments, where can I buy equity shares, where can I buy bonds. But very very rarely I came across this situation where I was able to find a preference share listed. Right, so I used to wonder, maybe it's all theory and maybe it does not have a practical use, right? And I was so wrong, because preference share is an extremely useful instrument in the market. So what we're going to learn now is the use of preference shares in structured finance. Okay, so I'm going to give you a few examples. Okay, use of preference shares in structured finance. In structured finance. Okay, I'm going to build some sort of a hypothetical situation for you, so you'll understand how this works. Okay, so use of preference shares in structured finance. All right. So imagine a classic a VC, a venture capital fund. Okay, imagine a venture capital fund, and what venture capital fund is doing is it is looking at a startup. Now you know that venture capitals could invest even when your business is just on a PPT, right? Even when you just have a very broad overview, like even you just have an idea, you've not even tested the product, you don't even have a minimum viable product, VCs would still give you money depending on your background. So they're looking at a business, the business wants money, and let's say the business wants a simple capital needed. Okay, a capital needed of, let us say, 100,000. All right. Now, what VC thinks is, let's look at scenario one. Okay, scenario one, that I invest today in the company where profitability is kind of down, and the company within 7 years. So this is time 0, and this is time 7. And let's say you get really lucky, and company hits an IPO here. Okay, that's the best case scenario. Happens very rarely in practice, but let's say within 7 years you get a mind-blowing exit. You make a lot of money here. Okay, and if you get this kind of exit, Of course you're making money, but what's the problem? The problem here is that you do go from T0 to T7, but there is no money made. There's no money made in first 7 years. Or instead of saying money made, there is no cash flow received. There is no cash flow received in the first 7 years, right? So it's kind of a dry investment for you. Cash flow received in first 7 years. So yes, you buy equity shares and you exit, you get cash flow. So what could be a solution? What's the solution? If you do a pure equity, you don't get the cash flow. Simply invest into a preference share. Okay, so if you do a preference share, what is the benefit? Benefit is that you will receive your preference dividend in these 7 years, right? But then how will you get equity at the end of the 7th year? So make this preference shares convertible, right? Make these preference shares convertible. So when you have your preference shares convertible, what is the benefit of that? Benefit is that for the first 7 years, you get preference dividend if the company is making profit. And if they, and at the end of 7th year, you convert yourself to equity. That's called convertible. You get best of both. But then he gets a question. He says, what if, he runs a what if scenario 2. What if the company goes like this? It makes losses and then, then it reaches the IPO, right? Then what about the lapse dividend? Okay, so what about the years in which company made losses? Company made losses. It is quite possible, right, that it will have a V-shaped recovery. So what about the years in which company made losses? And here is the answer. Then what you do is you have a convertible preferred stock. Okay, you also make them cumulative. So cumulative means if you are making losses here, no problem. Let me accumulate those dividend, and then you start paying me those dividend when you start making profits. I get priority before equity shareholder, even for the lapse dividend, right? So beautiful product called CCPPS. And then he runs a third scenario. So let me run that here. So let's say what if. So we'll run a scenario 3. What if you were hoping that company will go like this? Okay, but what if the company actually shoots up and it has a beautiful trajectory? What if the company makes a lot of profit from year 1, right? Especially if you have some solid patent. What if there is good profit pool in the first 7 years? Good profit in 7 years also. So as an investor, you want it all. You want to have a little bit of piece of everything, right? Now, if you do a CCPS, cumulative convertible preference shares, you do get dividend, but you get at a fixed rate, right? What you say is company is making a lot of profit. I want more of those profit. So what you can do is you can add in a cumulative convertible participating preference shares. So these are called CCPPS. And what do you mean by participating? It means if company's profit exceeds a threshold. For example, let's say if company's annual profit exceeds $1 million, then that incremental profit that the company has, मैं उसका 20% ले लूंगा. Or I will take 10% of it. I'll take 20% of it. I'll take 5% of it, whatever it might be, right? So it's a structured finance deal where you sit across the table, you negotiate with the company, and you use this instrument beautifully, but it protects you from most of the scenario. If you want to convert your preference shares to equity, make them convertible. Are they better than direct equity shares? Of course, yes, because you get some priority on the balance sheet. You're sitting above the common shareholders in case if things go wrong in liquidation. Plus, you get the dividend for the first 7 years if things go well. Then you don't want to lose out the dividend in which company is making losses, make them cumulative. So cumulative convertible. Plus, you want to have share of profits in case if the company makes really good performance, it has really good profits, make them participating. So cumulative convertible participating preference shares, CCPPS. It's a very common instrument used in a lot of private equity deals, and you can also structure it in different ways. Okay, there's a lot of flexibility in terms of how this could be structured, but we just wanted to build an overview of where is preference shares used in practice, and now you know that it could be used in a variety of situations, but very popular in VCs and private equity space. Okay, so quickly bringing you back to the umbrella topic, don't lose the big picture. What we are studying right now is cost of capital. We're learning how to raise money, and so far we've seen that I can raise money either through equity, or I can raise money through preference shares, or I can raise money through debt. These are the three ways. Now we looked at characteristics of each one of them, that how each of the product behaves, and then we looked at the scenario and we understood how CCPS or CCPPS is used in practice in the industry. Okay. Now, if you have any questions, feel free to put them in the chat box. I'll try and answer them. And if you've understood everything, just give me the command word, then we're good to move on. Any questions, any doubts, just put them on the box. I'll try and answer whatever I can. Mazara, are you enjoying this so far? Easy, fun, useful, practical? Are preferred shares and preference shares are same? Yes. I'll be using them interchangeably. A preferred share and a preference share, these terms I'll be using interchangeably. A preferential issue is a different concept. Okay, a preferential issue is something else that we'll worry about later on, not now. Do preference shares get redeemed at the same price they are bought? They generally redeemed if they are redeemable. That means if they have a limited maturity, Shahid, preference shares are purchased typically at their face values. Abhinav is asking, sir, what if investor has CCPS and company makes loss each year? What if investor has CCPS and company makes loss each year? Abhinav, the answer is you're a very bad investor. Then no instrument will protect you. No matter where you go, you're going to make losses. So don't invest. Then no instrument is going to protect you. Does CCPS have a lower dividend rate than a regular PS? So it depends. You know, it depends. You see, it's really about how do you structure a deal, right? So generally these are structured. It's a part of structured finance. Structured finance means where you customize, the features of that product based on the situation. So the investor and the company sits across the table. Typically, is the job of an investment banker, and he would, recommend that you structure it this way, you structure it that way. At times, if it's a company with significant patents and there's a lot of interest in you, then you can get away by, not even paying a preference dividend. Like you can structure a deal where you're paying just 1% or 0.5% of preference dividend. But if you're a company which is, struggling to raise money and somehow you've been able to convince the investor, he's going to squeeze you out. Then he's going to, ask you for a lot of sweeteners in the deal. He's going to ask you to pay a higher preference dividend or whatever it is. Okay. Now, with this background, let's start doing a little bit of mathematics. Where do you Where should we start, equity or debt? We can start either way. We can start with equity, go to bonds, go to prefer, and then we go to debt. Or debt is easy, so we start with debt, prefer, equity. How do you want to start? Let's start with debt. I think it will be fun. Let's start with debt. We'll get to do some TVM fun with it. Okay, so let's start working on the cost of debt. You're going to have a lot of fun. Sit tight, stay focused. Stay focused. I think in a couple of hours, we should be able to do a nice overview of what this reading is, and then we'll get granular and start looking at more in-depth concept. So let's look at cost of debt first. Okay, and I'm going to write down a sentence. This sentence is going to be a 3-star. Okay, this sentence is a high probability section. High probability of showing up on the exam, high probability of you making a mistake on the exam if you don't remember it or if you don't understand this well. Okay, so let's write this together. Cost of debt, KD. Okay, so right now I'm just writing KD. Remember, I'm not writing KED. Can you notice when I did the notations with you, I told you that for debt, we will be writing KED, but right now I'm not doing that. Right now I'm just writing KD. Okay, you'll understand very soon why that's happening. We'll go there. Just work with me on this sentence. If you have a post-it nearby, write it down. Okay, so cost of debt, KD, of a company, cost of debt of a company is YTM at the time of issuance. YTM at the time of issuance, not the coupon rate. Okay, extremely important. Cost of debt of a company is YTM at the time of bond issuance, not the coupon rate. Okay, let me emphasize on this. This is important. I want you to remember this. This has to be internalized. I'm going to exaggerate a little bit, maybe dramatize this. YTM, coupon. Which one of these is the cost of debt? YTM, yes. Coupon, no. It's a very common trap. That's why I'm focusing on it so much. Cost of debt of a company might look like it's the coupon rate, but it's not. The cost of debt of the company is a YTM. Okay. And in fact, my apologies. Let me delete this. Just say YTM at the time of issuance. In fact, good. At the time of issuance, no, not necessary. So in fact, let's eliminate this at the time of issuance. Okay. Let it remain in your sentence, but strike it out. I'll tell you later on why. Okay. So just say cost of a debt of a company is YTM, not the coupon rate. Now, what does it mean? I'm going to show it to you. Imagine we have a company which has data like this. Okay. So let's do our example number 1. Let's do the first example. Let us say we have a company which has issued the debt or issued the bonds. It issued at the face value of 1,000. Coupon rate 12% paid annually. Okay, so it's an annual coupon. Maturity is let us say 10 years. Okay. Now the market value of the bond could be anything. So let us say the market value of the bond. We'll do different scenario. Scenario 1. Okay. Scenario 2. Scenario 1. Scenario 2. And scenario 3. All right. Let's say market value of the bond is 900. Market value of the bond is 1,000. And market value of the bond is, let us say, 1,200. Okay, now in each of the scenario, we want to figure out what is the cost of debt. On the exam, you'll be very inclined to select that 12 and move on, but that is going to be a wrong answer. If you think 12 is the cost of debt, that is a wrong answer. You don't want to do that. What you want to do is you want to figure out what is the YTM of the bond that the company is issued. Now, if you've done bonds, you would know how to do YTM. YTM stands for yield to maturity. But if you've not done bonds, it's perfectly all right. I'll show you how to do it. It's very simple. The way you want to do YTM is you're going to say 1,000. Okay, let me write it down here for you somewhere. Okay, 1,000 is future value because on maturity we receive 1,000. Okay, this 1,000 we receive back on maturity. Every year we receive a coupon which is 1,000 into 12%. So 120 every year we receive, that's payment. How many years? What is the maturity of the bond? 10 years, right? So 10 is going to be N. 10 is going to be N. And market value will change. So let's take scenario 1. So we will keep 900 negative because I have to pay that much of money. So 900 negative is the present value. So insert this in your TVM row of the calculator and then hit compute IY button, interest oblique yield, compute IY, and tell me what YTM are you getting here? What's the YTM? Scenario 1, what is your YTM? Scenario 1, what's your YTM? Come on, I'm waiting for you. Help me out with your answers here. Scenario 1, YTM is 13.9%. All right. Scenario 2 is how much? Scenario 2, YTM is 12%. And scenario 3, if you keep 1200 negative as present value and do compute IY, scenario 3, what YTM are you getting? Scenario 3, your YTM I think is 8.89. I have not done the math myself. I'm just relying on the chat box. Please confirm if these three numbers are correct. Please confirm if these three numbers are correct. Scenario 1, 13.9, 12, and 8.89. Is this correct? So what do we learn from this, right? We learn that as the market price of the bond is changing, the YTM is changing, that's obvious. And that YTM is the true cost of debt for the company. Okay. That YTM is true cost of debt. It's not the coupon rate. It's not the coupon rate. It is the YTM. Now, the question is why YTM and why not the coupon? Because of course, what you would think is, you would think that Utkarsh, this doesn't make sense. Every year, company is paying 120. Now it doesn't matter, what is the market value of the bond. Every year, as a company, I have to pay 120. So how come you're saying 13.9 is the cost? It doesn't make sense, right? So here's the answer. Okay, here's the answer to the question: why YTM and not the coupon rate? Okay, this I want you to look at very, very carefully. It's not explained really well, in the curriculum. I mean, they have, but in slightly technical language. So I just want you to listen to this with all your focus. Okay, why YTM? Why current YTM? Why current YTM and not coupon? And not coupon rate. Okay, why current YTM and not the coupon rate? There's a little bit of logic behind this, and I want you to understand this. So think of year 2000 and okay, I'm going to build a hypothetical example, something to which all of us would be able to relate to. So think of maybe year 2000. Okay, and think of a Think of a company, give me a name of a company which was probably popular back then, but now is not at all doing good. Think of a company which, give me an example of a company which was probably very popular back then, uh, but not doing so good today. Maybe a hot company those days, but not doing so great today. Okay, let us say, let me make up something. Okay, so let's say Kodak, maybe the camera company. I don't know. I don't track that stock, but I'm just guessing. I'm just guessing that uh, Kodak, uh, or maybe in India we had the correct BSNL is a great example. Nokia, maybe. Uh, Nokia is a great example. Whatever. Okay, we've like a lot of companies, right? So think of any of these companies. Let us say these guys go in the market and then say we want to issue. Okay, this is year 2000. We want to issue, let's say, a 30-year bond. We want to issue a 30-year bond. Um, what should be the coupon rate? What should be the coupon rate? Okay. Now let's assume that this is market. So let's make this guy. Okay. Let's say that this is the market. Okay. Just making up, just to kind of dramatize a little bit. So market looks at these guys, who are very popular then, and market thinks, okay, these are very safe, no problem, no problem. Uh, you give me a coupon of only, let's say, 5%. All right. So then the Kodak or the BSNL or Nokia, the popular companies, then this is okay. Okay. Coupon rate of 5%, let's say maturity of 30 years. Coupon rate of 5%, maturity of 30 years. All right. So in year 2000, they issued the bond, coupon rate of 5%, maturity 30 years, end of the story. Now, this is year 2021. This is year 2021. What is the coupon rate of this bond? 5%. What is the remaining maturity? Help me out here, please. What is the remaining maturity on these bonds? Remaining maturity on these bonds, we generally call this as tenor, is about 9 years. Now, Kodak slash BSNL slash Nokia, whatever, popular companies at one time, they go to the market again today, okay, and they say, we want to issue a new bond today. We want to issue a new bond today. Is 5% okay? Now, this guy's market, this guy's bond market on an average. What do you think? What do you think? Is he going to say, is he going to say they're very safe? Is he going to say they're very safe? Or he's going to say dead companies, risky companies? He's going to say risky. So when they come to him and he says, is 5% okay for a new bond if I want to issue today? Do you think he will say yes? Absolutely not. No. He will say, no, you're a risky company. If you want to issue a new bond today, pay me 15%. If you want to issue a new bond today, pay me 15%, because today's situation is different than what was the situation when you issued the bond. And it doesn't always have to be situation with respect to credit risk of the company. It could also be that overall interest rates have gone up, inflation have gone up. It could be anything, right? It could be a variety of situation. But today, if you want to issue new bond, the rate is going to be 15%. Guys, this number is nothing but, you must have guessed, this number is nothing but what? YTM. Okay. So when you're calculating the YTM on a bond, What you're really calculating is how much market expects to earn on a bond with this type of risk in today's environment. If this company were to issue a new bond today, what would be the coupon rate at which they will issue the bond? So that bond will trade at a face value that is going to be 15%. Okay. And now the last leg of this explanation, that in when we are calculating cost of debt, okay, in general, when we are calculating anything, when we are calculating cost of capital, okay, in this reading and in general everywhere, okay, uh, it's not for it's not for past, rather it's for future project. Rather it's for future project. We are using past data, but we are trying to figure out, if I do a new project today, then how much will it cost me? And because we are always doing it for future projects, therefore we don't use past coupon rate, because that might have determined few years ago. Don't use past coupon rate. Don't use past coupon rate. Instead use current YTM, because current YTM is reflecting the true situation of the company in today's market. So therefore use current YTM. And hopefully this answers the question, why not the coupon rate and why the YTM? You want to use the YTM because that indicates that if I raise new money today, I will not get to raise money at the old coupon rate. I'll get to raise money at the current YTM, which means if they want to issue the bond today in the market, will they issue at 5% or 15? Of course, 15, right? Because that's kind of at par with the level of risk company has today. So this is the rate that we want to use as a cost of debt. Now, if you've understood this, give me the command word on the box. If you've understood this, give me the command word on the box. You've understood what? You've understood why use YTM and why not use the coupon rate. Just give me a command word. And if you want to ask a query, I'll try and answer it for you. YTM stands for yield to maturity, Ananya. Yield to maturity. All right. Happy to know you guys are understanding. Let's practice a little bit more. I want you guys to get comfortable with the YTM maths. It's easy, but just to be sure. So let's practice a few questions. Okay. In general, I think there are two versions of questions you're looking at. We're going to try and do both of them. Let's say face value of 1,000, coupon rate of 10%, maturity of 10 years, all right, and market value of, let's say, 800. Figure out what would be cost of debt. What is the cost of debt? So let me just call this as KD. Save the space. Let's call this as KD, not KED, is just KD for the timing. Okay. In the same way, second bond. Now this 10% here is, by the way, an annual coupon paid once a year. Second bond, face value 1,000, coupon rate 10% per annum. Okay, it's per annum, paid semi-annually. This is where I'm betting my money on. This is a 3-star. To me, this scenario is more likely, in my opinion. It's a guess, but I would say that this is more likely to be tested. Paid semi-annually. Paid semi-annually. Let's say maturity of 10 years, and let's say market value of, we'll keep it same, market value of 800. Okay, so I want you to solve these two side by side. They might look similar, but there's a small difference in the two. and I want you to do the YTM calculations here. Come on, get started, please. Come on, do both the YTMs here. Give me a number that you have. Okay, so how do you do it on a TVM row? TVM row, assuming a Texas Instrument calculator. Here's the math you want to use. You would say face value 1000, PMT, enter 100, N, enter 10, present value, enter negative 800, because you have to pay 800 to buy the bond, then you get 100 every year. And then you're going to do a compute IY, and the first answer people are giving me on the chat box is 13.8%. So that's your YTM, that's your cost of debt. Let's look at the second one. Again, you go on the time value of money row of the calculator. If you don't know how to make use of the Texas calculators, I have plenty of videos on YouTube. Look them up, they'll help you out with that. So face value 1000, but things are going to be different here. Payment, even though it's coupon rate same, but now I'm not going to receive 100 every year. Instead, I'm going to receive 50 every 6 months. So because I receive money every 6 months, my payment is going to be 5050, not 100. And I received 100 10 times, but 50 I'm going to receive 20 times. Present value is same. Present value is 800. Compute I buy, but hold on a minute. This would be the interest rate for semi-annual basis. It would be interest rate for 6 months. We multiply by 2, and that's when we get our true YTM. Your true YTM is coming out to be 13.73%. Okay, so you should be able to handle both. You should be able to handle calculations on a semi-annual basis. You should be able to handle calculations on the annual basis. Okay, so I hope you are clear with this. Are you comfortable? Guys, are you okay with this so far? So next, do the next concept now. It's linked to the cost of debt. We will do it for another 20-30 minutes, 20 minutes at tops, and I'll give you a nice break. Okay. But this is important. This is fun. So I want you to listen to this carefully. What we're doing next is a super cool concept. Misunderstood, but beautiful concept. It's called 20 minutes. You're going to get a break, but you're going to listen to me very carefully now. Okay. This is critical. We're getting into core area of this reading. So next thing that we want to learn is something called as the tax shield. Okay, so what is a tax shield? I'm going to try and explain that to you with the help of a nice example. Let us say we have started a new business. We have started a new business. This new business requires us to have a total capital of 200. Okay, total capital that we require is 200. We have decided that we're going to raise the whole 200 in the form of equity. So entire 200 is going to be in equity. And how much is the debt going to be? Debt going to be 0. All right. Now we start the business, the things start working well for us. So we'll be making an income statement. Let's say sales, we make about 1,000. All the operating cost, okay, all the operating cost, we have, let's say about, I don't know, all the operating costs we have, let us say about 900. So then we get a number. We call that number as EBIT. Okay, so let's say EBIT is 100. Then we deduct interest. You guys, please help me out. How much should be interest? How should I calculate that? What's the amount of interest I'm paying here? The interest is going to be correct. It's going to be 0. Why is it 0? Because there's no debt. Why would you pay any interest, right? So interest is 0. So you would be left with something called as earning before paying any tax, profit before tax. How much is that? 100. What is the tax rate? So let's assume some tax rate. Let us say tax rate is, let me make up 40%. All right. So if tax rate is 40%, how much tax should I pay on profit of 100? I should pay a tax of 4040. And once I pay a tax of 4040, what is my net profit? What is my earning after tax? Earning after tax, also called as net profit, also called as PAT, also called as net income. We use all these terms interchangeably. Okay. So the net profit that's left for me is 60. Now, this is how the income statement is working, and it's working well. Now what we do is we decide, what if I change my capital composition a little bit? Okay, what if I have the capital of 200, but now what I'm going to do is I'm going to bring in half. I'm going to bring in equity of 100, and I'm going to bring in debt of another 100. And of course, the moment I bring in debt, will have to pay a little bit of cost. So let us say the cost of debt at 10%. All right. Now don't do any high level maths. Just give me a number of amount of interest that we have to pay. An amount of interest that we have to pay. Now, how much interest we have to pay here? If I've taken debt of 100, and if the cost of debt is 10%, what do you think will be the interest payment? 10, right? Interest payment will be 10. So without any debt, my profit was 60. If I am taken a debt of 10, what do you think would be the profit number now? With debt, what do you think would be the profit number now? It should reduce by 10, right? So it should be 50, or at least that's what it looks like, because I have to pay extra interest of 10, which I did not pay earlier. So my profit will come down, right? So my profit will be maybe now 50. Okay. Now let's do this. This is going to be a lot of fun. All right. I want you to look at this carefully. Sales 1,000. Operating cost. I will try to write it in a structured way so that when you're studying it, it's a little easier for you. Operating cost. This PDF is available. You don't have to bother about writing. Okay. Just learn. Learning is important. Operating cost 900. EBIT 100. So far, so good. So far, everything is matching. Good news. Interest. That's where the cost comes in. Interest. How much? Interest is now going to become 10. Now, because interest has become 10, let's see how much my EBT is. Now my EBT is going to be 90. And then what would be the amount of tax? It's 40% of EBT. So it's 40% of 90. So 40% of 90, the amount of taxes that I have to pay, okay, the amount of taxes that I have to pay, now that number is going to be 36. And if I have to pay a tax of 36, let's figure out how much would be my net profit. So my net profit here, we give it different names, but my net profit here is going to be 50, is going to be 54. Is that correct? My net profit is going to be 54. So this is kind of strange. This is strange because I thought my net profit would be 50, but apparently my net profit is, my net profit is 54, right? My net profit is 54. It is not reduced by 10. It is reduced only by 6. It is reduced only by 6. It's kind of strange, right? Because I'm paying an interest of 10. So I thought my net profit will reduce by 10, but actually my net profit reduced only by 6. It's reduced only by 6. So it looks like 6 is my true cost, not 10. Agree? 6 is my true cost because my profit has only reduced by 6. Earlier it was 60, now it is 54. Now tell me why. Tell me why. Why has my profit reduced by 6 as against reducing by 10? I'm sure you guessed it right. The reason why your profit reduced by that amount was because you paid interest of 10. So your interest cost was 10. So your profit should have reduced by 10, but you paid less amount of taxes of 4, right? You got benefit of 4. So therefore, that lesser amount of 4, resulted into losses of or reduction of profit of only 6. Correct? Look at this. Here you pay tax of 40. Here you're paying tax of 36. So that 4, that 4 is some sort of, think of it as some sort of a, it's stupid, but it works. Think of it as some sort of a discount given by the tax department. Discount given by the tax department, right? So it's stupid, but just learn to think of it this way. Let's say that bank, and the income tax department, okay, whatever the income tax department that exists in your country, they are running some sort of a joint promotion. It's like, the advertisement is take a loan. So just make this screen out. I don't know what's happening here. Yes. Okay. I hope it's not internet. It looks like it is. Is the patient improved? Be patient. I split a minute. Wait, it'll improve. What? How is it now? Is it better? Is it better now? Okay. Just a minute, please. Okay, I think it's come back, but my screen is not working the way it's supposed to work.
So, you can turn off the video.
Fine. Sure, I cannot access my screen. That's where it's stuck. Yes. Sorry, type करूँ? हाँ, but I have lost. Okay, good. Okay, how is the streaming quality? Is it good enough? Can I take control of the screen back? Okay, good. Thank you. All right. My apologies. I'm so sorry. I hope I've lost the notes. My computer had to shut down, or it was a forced shutdown, and it's unfortunate because it looks like there were notes we had prepared. Those got deleted. So I'm so sorry. Session notes from this class won't be available. Maybe we will try to take screenshots and reproduce them, but they would definitely be not of the same quality that we were working before. Okay, so my apologies one more time. I tried to be careful. We had a couple of Wi-Fi connections, but that's the state of affairs, unfortunately, in India. It is what it is. So let us start. Before the break, I was talking about the two situations where we had prepared income statement. In one situation, we had taken we had total capital of 200 broken down into equity of 100 and debt of 100. Correct? This debt of 100 was brought on at 100 rupees or 10%. Now, in another situation, we had capital of 200, which was all equity, no debt. Now, the net profit number that I had with a tax rate of 40%, by the way, tax rate of 40%, the net profit that I had was, I don't remember, what was the number? 50? No, I think it was 100, right? The net profit that I had, what was it? 60? I'm so sorry, I'm completely blank. What was the net profit we had in the before situation where all equity capital? 100, I guess. No, what was it? 60. Okay. So net profit was 60. And when you took the debt, the net profit came out to be 54, right? So 60, 54. So based on this, we calculated what would be the true cost. And what was the true cost? True cost was 6. Now the question was why the true cost is 6 if I'm paying interest of 4. So I was trying to explain you, and that's when I think the internet shut down. So I want you to think of it as some sort of a collective scheme run by the bank and the tax guys, the income tax guys. And the scheme works a little bit like this. It's like if you take a loan, okay, then we'll give you some tax waiver. That's a very loose way of looking at things, but it will help you build concept. We'll give you some tax waiver. Now, what do you mean by tax waiver, right? So a technical answer to this, like what does it mean technically, is that interest is a tax deductible expenditure. All right. So I want you to listen to this super carefully now. Interest is a tax deductible expenditure. Now, what does it mean? It means if you pay interest, okay, it reduces your PBT, profit before tax. And if you reduce your PBT, then your tax expense is reduced. Okay. Now, paying interest is, some sort of a item which will reduce profit, or reduce, it will increase your cost. Let me say it that way. It will increase your cost. But reducing tax expenditure is going to reduce your cost. So we have some sort of a compensating effect that's playing out here. Every time I pay interest, my cost of debt, my tax expenditure is going to come down, right? So if you look at this example, what really happened is I paid an interest in the previous example. The interest paid amount was how much? Interest paid was 10 rupees. But tax benefit was how much? Because I paid interest, tax benefit was how much? 4. So what was my net cost? My net cost came out to be 6. Net cost came out to be 6. This is a true cost. In percentage term, we will say this is 10% of what? Of loan amount of 100. This is 4%. So what's the effective cost? Effective cost is coming out to be 6%. So this 6% here, okay, this 6% here, this we call as, this 6% here, this we call as, let me just write it here in the corner. This is referred to as effective cost of debt. Effective cost of debt, okay, KED. Effective cost of debt, KED. Now that E comes in, right? I told you there will be a E coming in later on. What is that E? That's for the tax shield benefit. So because interest is a, I hope you're listening now. Okay, now it's critical. 10 minutes, you get a break. Okay, 10 minutes, we're more or less done with the debt part. Because interest is a tax deductible expenditure. What does it mean? It means I pay interest, which reduces my profit. Reduces my profit, I pay less taxes. Because interest is tax deductible, we get the benefit of reduction of taxes, which helps us reduce the cost of debt. So the way you're going to think of it, extremely important table on your screen now. The formula that we use is, we say effective cost of debt is equal to YTM, whatever is a YTM, multiplied with 1 minus the T, which is the tax rate. Okay, now it looks like a fancy formula, but it's actually very easy. I'll show you a few situations. Let's work on this together. Okay, so we'll make a nice column where we'll write down YTM, we'll write down tax rate, and I want you to figure out what would be the KED. All right, let's do a few situations. It'll come to you automatically. You don't even need a calculator to do this. Let's say YTM is 10% and tax rate is 40%. What would be the effective cost of debt? So how do you think of it in your mind? You think that if tax rate is 40, I'm going to multiply 10 with 60%, 1 minus T. So when I multiply 10% with 60%, what do I get? I get 6%. So that's your effective cost of debt. Okay, one more. Let's say YTM is 12% and tax rate is 30%. So now what you're going to think? You're going to think that to 12%, I'm going to multiply with 70%. Do it on the calculator. 12 into 0.7. Okay, what will you get? You will get 8.4%. All right, one more just for practice, just so that you feel comfortable with this. Let's say YTM is 15% and tax rate is, let us say, 40%. So what will you do now? You will take 15. Come on, help me out with this. You will take 15 and 15 you would multiply with how much? 15 you would multiply with 0.6 or 60%. And what would you get then? You will get 9%. Are you getting the hang of it? That's how you calculate the effective cost of debt. Let us say YTM is 20% and tax rate is 10%. What will you do now? You will take 20%, you will take 20% and multiply that with 90%, right? So 20 or 0.20 into 0.90 or 20 into 90%, whatever way it works for you. How much? 18%. Okay, and last one now, let's say this is 5 and let's say this is, I don't know, let me make up something, 30%. So 5 into 70%, how much is that going to be? That's going to be 3.5. Okay, so that's how you do effective cost of debt. So to the cost of debt, there were two pieces to it. What were the two pieces? Number one, we don't use the coupon rate. No, we don't use the coupon rate. We understood why. Because we are looking at future, not at the past. We're not looking at what company is paying today. We're looking at what company will have to pay if there is new debt for a new project in future. So we're not going to use coupon, we're going to use YTM. But at the same time, we're going to make sure that we get the benefit of the tax shield. So YTM, tax shield, you kind of not the pieces tightly and job done. If you kind of get these pieces together, job done. That's how you're going to do cost of debt calculations. Okay. So a final example, and then we are going to close the session here. So a final example before we close the session. This is, in my opinion, the a representative example of what you might see. If I had to write a question for you, this is how I would write the question. Okay. So let's say face value of a bond is 1000, coupon rate is 12% per annum, semi-annual. Don't miss this. Okay, don't blame on me later on saying, I missed this. Utkarsh, you were not explicit. I missed this. No, please, semi-annual, half. You'd be receiving coupon twice a year, semi-annual. Let's say maturity of 10 years. And let us say the market value of this bond today is let's say 600. And let us say the tax rate is 40%. Based on this information, now I want you to figure out what will be the effective cost of debt, not cost of debt. Now I want effective cost of debt. Okay, effective cost of debt is KED. Get started. Effective cost of debt. Tell me how much. Effective cost of debt, how much do you think that's going to be? So here's how you're going to do it. Step number one is, of course, to figure out what's the YTM, right? So we'll say second and clear TVM on a Texas calculator. 1000 is the future value, FV. 6060 is the payment. That's half of 120. 20 would be N. 600 negative should be your present value. And then you do compute CPT IY. Okay. Now, once you've done compute IY, that's not going to be your YTM. That's going to be half year yield, multiply with 2. So let's figure out first what the YTM is. Okay. So I am using the Texas Instrument app on my mobile phone. Second, clear TVM, 1000 future value, 60 payment, 20 N, 600 negative present value, compute IY. I'm getting 11.03 as a YY. I'm going to multiply that with 2. So my cost of debt looks like pretty high. It's 22.068. What is this? This is YTM. But the effective cost of debt is going to be not the YTM. It's going to be YTM into 1 minus T. So it's going to be 22.068 multiplied with tax rate is given as how much? 40%. So 1 minus T means 100 minus 40%. So how much is that going to be? 60%. So let's multiply this with 60%. So into 0.6, and it looks like the final answer is coming out to be, come on, tell me how much. I'm getting 13.24 percentage. And if you got this answer right, congratulations. 1/3 of this reading is over. Okay, so you have to learn, work on the three pieces. You have to work on the cost of debt, the cost of preferred stock, cost of equity, and some theory here and there. So the first part of that is done. You know how to calculate the cost of effective debt. All right, so give me a command word. Today's session command word is yo-yo. And the number of yo-yos that you give me is a function of how well you've understood this. So better you understand, the more command words you throw on the box. Good. I love the enthusiasm. All right. My apologies again one more time for the internet glitch that we had. Otherwise, we were having good time, and I kind of lost your notes. We can try to rebuild them with. We can try to rebuild them with screenshots. The quality is not going to be great, but it is what it is. So now, I hope you enjoyed this session. The subsequent parts of this session, I'm going to do it on the Zoom panel. Okay, so now what we're going to do is we will take a break. This is about 6:50 India time. You guys can come back by 7:20 p.m. IST India time on the Zoom link. Okay, on the usual Zoom link where we do our regular sessions. And before you go, please do like, comment, and subscribe on the channel. It just helps us with the YouTube algorithm. All right, so thank you very much. And then whatever questions you have, you can feel free to either write them in the comment box, or you can ask them to me in the Zoom session once we start. All right, so thank you. You guys have a good one. Signing off now.